This indicator provides two types of signals: reversal signals that appear when a trend is about to change direction, and buy and sell signals that appear while a trend is already in motion. Let's go ahead and add it to the chart now. Click on the Indicators button and search for Trend Reversal Probability Calculator. Select the one authored by Cyatophyllum, or at least that's the closest pronunciation. Once added, you'll notice that the indicator displays directly on top of the price chart as an overlay. This tool is built on a foundation of 11 moving averages. It also incorporates the rate of change, commonly referred to as ROC, which is used to calculate the statistical probability that the current trend is about to reverse. However, we will not be relying solely on these signals or the reversal probability alone when deciding to enter a trade. We will be layering additional confirmations on top of these signals to reduce our overall risk exposure as much as possible. Before anything else, we need to adjust the default settings so the indicator performs at its best for this particular strategy. Open the settings panel of the indicator. Inside, you will see 11 moving averages listed, each with default lengths of 10, 20, 30, 40, and so on up to 200. The only change we need to make to the moving average lengths is the longest one, the one that was set to 200. We will change this value to 144, which is an optimized length for the trading strategy being discussed here. All other moving averages, from length 10 through 100, remain unchanged. After that, locate the ROC length setting and change it to 20. This adjustment fine-tunes the sensitivity of the indicator, so it aligns properly with our approach. Now that the settings are dialed in, let's take a look at what the indicator is actually showing us on the chart. You'll notice 11 moving averages are plotted. The thinner lines span from length 10 to 100. The thicker line, which shifts between green and red depending on the prevailing trend direction, is the moving average with a length of 144, the one we manually set. As mentioned, the indicator generates two kinds of signals. There are reversal signals, which appear when the indicator detects a probable trend change, and there are buy and sell signals that occur during an already active trend. For this strategy, the primary focus is on reversal signals. However, if you also want to use the trend-based buy and sell signals, you will need an additional layer of confirmation to ensure you are not acting on signals that appear in a sideways or ranging market. For example, a signal appearing during a flat ranging market is considered a false signal and has little trading value. A signal that appears when the market is genuinely trending, on the other hand, can carry strong follow-through. One useful tool for filtering out flat market signals is the Aroon Oscillator. When the Aroon Oscillator's orange line is positioned above the other two lines, it signals that the market is essentially going sideways, meaning any buy or sell signals during that phase should be ignored. But when the red line is above the other lines, it indicates a declining trend is in place, which gives greater confidence in acting on a sell signal. Regardless, the buy and sell signals within a trend are secondary for this strategy. We only act on them once a trend has been clearly confirmed and established. And as you'll see in a moment, the reversal confirmation process itself already filters out many of those premature signals before you even get to that stage. Now, let's walk through the actual reversal trading strategy. Remove the Aroon Oscillator from the chart and add a second indicator. Click on Indicators and search for RSI. Select the Relative Strength Index. We will use the RSI specifically to identify divergence, which is a leading signal indicating that a trend may be losing strength. Here is how divergence works in this context. Suppose the price has been forming higher highs and higher lows during an uptrend, and then at a certain point, the price reaches roughly the same level it reached before. This in itself signals that the bullish momentum is starting to fade. When you look at the RSI at that same moment and notice it has formed a lower high, even though the price formed an equal or higher high, this is called bearish divergence. It tells you that upside momentum is weakening while downside pressure is beginning to build. This is the first signal that a reversal could be forming. It is important to understand that divergence does not guarantee a reversal. It can sometimes precede only a minor pullback, a move into a consolidation range, or in stronger cases, a full trend reversal. Divergence is simply a signal that the existing trend is weakening. That weakness alone is not sufficient reason to enter a trade. The 144-period moving average also serves a key function in this strategy. It acts as a benchmark for evaluating trend direction. When price is in an uptrend, it tends to stay above this line. When price is in a downtrend, it stays below it. A crossover, when price moves from above the line to below it, or vice versa, is interpreted as a second signal that a trend change may be in progress. For a short trade setup, the three-step confirmation process works like this. First, bearish RSI divergence must be present. Second, the price must cross below the 144-period moving average. Third, the trend reversal probability calculator must generate a reversal signal. Once all three are aligned, a short entry is considered valid. The stop loss is placed above the most recent swing high, and the profit target is set at a risk-to-reward ratio of 2. For a long trade setup, the same process applies in reverse. Look for bullish RSI divergence, price making a lower low, while RSI forms a higher low. Then wait for price to cross above the 144-period moving average. And finally, confirm with a reversal signal from the indicator. When all three conditions are met, a long entry is taken. The stop loss is placed below the most recent swing low, ideally just beneath a small pause in the price action, which makes it a more logical and tighter placement. The profit target again uses a risk-to-reward ratio of 2. This strategy is designed to provide low-risk, high-probability trading setups. However, no strategy eliminates risk entirely, and no system achieves a perfect win rate. Disciplined risk management is essential. The 1% rule, never risking more than 1% of your capital on a single trade, is widely recognized among professional traders as the cornerstone of sustainable trading. Without proper risk management, consistent profitability over the long run is extremely difficult to achieve, regardless of how strong your entry signals may be.